Good afternoon. My name is Asi Arkest and I'm your moderator for this afternoon's session. Welcome to the EBII Africa Investment, Risk and Compliance Summit. Emerging Business Intelligence and Innovation is an emerging market interface for businesses in the West and Africa. It aims to demystify the risk associated with Africa, providing real insights to investors through its EBII compliance function, EBII Invest in Africa program, and EBII Leadership Forum. During this afternoon session, we will address conducting investment due diligence in Africa post-COVID-19. Thank you all for your participation. A few housekeeping points to note before we start. You can send in your questions during the session and we will address as many of them as possible. Kindly note that this summit is being conducted under the Chatham House rules. Thus, although information disclosed during the summit may be reported by those present, the source of that information may not be explicitly or implicitly identified. Since the beginning of the year, many African countries have been scrambling to respond adequately to the COVID-19 pandemic, implementing measures such as nationwide lockdowns, curfews, and social distancing protocols. As time passes and it becomes increasingly apparent that the changes accompanying the onset of the pandemic are here to stay, many nations are coming to terms with a new normal. The real-world implications of COVID-19 on a continent like Africa are that it is forcing investors to adapt their normal investment behaviors in the short term and to reconsider their longer-term strategies. Due diligence in the West can be conducted on any stock using readily available public information. However, in most countries in Africa, investor due diligence is an activity that is predominantly conducted in person. Information is not publicly available, and even where stored and verified by an independent third party, there's a need to physically access it. This is because capital markets are not as developed and a large proportion of economic activity falls within the informal sector. We will see situations where there are winners and losers based on their level of preparedness. The governments that have prepared their economies for the new world by embracing digital transformation are going to reap the benefits of their foresight, and we will begin to see the impact in the race to attract investments. To help us discuss and address some of the most common challenges facing the investing community in Africa, I have here with me Anne Rana Singh, a British national who is intimately acquainted with Africa, having most recently been based in Gabon. Anne has substantial experience in the African space, risk management, operations, and finance. She is a Senior Director, Risk at Africa 50, an Africa Infrastructure Fund. Welcome to the panel, Anne.
Thank you very much, Asi, and thank you for your introduction. Good afternoon, everyone. It's a real pleasure to be with you today. Asi, are you okay for me to carry on? Or?
No, I just want to introduce Emmanuel as well.
Sure.
Okay. I also have Emmanuel Nambwari, who has a quintessential Pan-African profile. Although originally from Zimbabwe, he has lived and worked across the continent, notably in Ghana and Cote d'Ivoire. He is currently Executive Director, Fixed Income and Capital Markets, Matha Capital, a financial advisory firm based in Cote d'Ivoire with active mandates in more than 8 sub-Saharan countries. Welcome to the panel, Emmanuel.
Thank you very much, Asi. Thank you for the introduction.
Okay, so without further ado, we'll just go into the question and answer session to get the ball rolling. Emmanuel, it is undeniable that investors need to have faith in the due diligence process. Given the current changes that we are currently undergoing, what do you think governments and policymakers need to put in place to ensure this? In your response, can you also touch on some of the inherent risks and how prepared stakeholders are?
Sure, thank you very much. Thank you for the opportunity from EBII and we are proud to be associated with this session as well as Mata Capital. You know, I would say the impact of the pandemic has quickly created some kind of cliche words like the new normal. And I tend to really like try to see how that sits in the minds of people when you start to have words like new normal. And it appears as if cliche words like that would paint the new normal as if it were a static event, something that just happened and it will stay like that forever. One of the things that we've learned from the pandemic is that it has forced us, or it has forced businesses, investors, and issuers of investment instruments at the same time to really be very, very dynamic and actually like to start to look at risks at a much more wider basis than what they used to look at. And we are looking at risk also with a lot more in-depth analysis. So some of the risks beyond the normal due diligence risks that you would look at when you are looking at the capability of your investment to return you the required yield. Some of them actually are a little bit more dynamic. I think I'll give quite a quick example here. One of the things that we noticed in March and April at the height of the panic during the time that the pandemic set in many countries was that the markets became quite a lot volatile, and foreign exchange risk actually became quite elevated above all types of risks, especially if we look at Africa, the fact that we are generally huge importers of different goods, and our budgets as Africa have also like started to depend quite a lot on things like Eurobonds, bilateral loans, and also like to depend on foreign investors, even on our local bonds. So from a capital markets perspective, I would say is the dynamism that we actually like now need to look at in terms of sorting out our view of due diligence in Africa. One of the key things as well that I would actually like want to say is in addition to just like the foreign exchange risk, we have seen that liquidity is actually like becoming a problem, right? Where in the West, or actually like in the USA, they've got quantitative easing in different formats and coming through. We do not have the huge capacity to generate and to create liquidity in our markets. That's one thing. The other part of the liquidity also is that you find that most of our African governments, businesses, and also like most of the infrastructure projects that we were working on are dependent on liquidity that comes from abroad. And because of the disturbances or the interruptions that we have seen, we now start to see that a lot of the things are now pulled back in terms of the timelines. So that is actually like quite a very important kind of a risk to look at when you're doing your due diligence in terms of the static things, number one, but also looking at the things that will be dynamic in terms of what you are going to get out of the yields that you're going to get out of your investment projects. Or actually, if you're looking at portfolio investors, if you're looking at Euro bonds or actually local currency bonds, even if you're looking at the stock markets, those are really very important issues and risks that have got to be added on, that have got to be like looked at on a futuristic basis. I think I'll stop here and then probably continue later with the other questions.
Thank you, Emmanuel. Just to follow up on your response, I think you quite clearly outlined foreign exchange risk, liquidity risks. You mentioned some other phenomena that we're seeing happening, but you didn't quite talk about what you think governments and policymakers can put in place to make sure that those risks do not overwhelm their economies.
Thank you very much for coming back on that. I think I will just like start from how these risks are actually like impacting in terms of governments and also like how they're impacting in terms of the investor community as well. So let me just like single out the Eurobond on its own. as one of the key items that probably governments should be concerned with. You find that maybe if we take ourselves back 1 decade and we look at possibly at the time of 2009, 2008, at the height of the financial crisis, there was quite a lot of liquidity that was available in the markets in response to the financial crisis. And it so coincides with situations where African governments were starting to issue Eurobonds in very big, significant volumes. Now, with that all coming through, and most of these Eurobonds were issued, some of them are like for 10 years and so forth. So we have Eurobonds that were issued about 10 years ago, and they're coming now to maturity. What has been happening, or what has been the evolution of exchange rates for African issuers? Because what happens is you have issued a Eurobond today at one exchange rate, and if your exchange rate locally is always depreciating, it means in all the cycles of paying the coupons, you are paying even more and more. So those are some of the risks that probably the issuers of African bonds would actually be looking at, which is really very important. I'm not saying that nothing is actually happening in that space. There are some countries already that are already starting to look at that as a risk and trying to figure out and or are already working on mitigating that risk. So you find that I could say maybe single out countries like Senegal, I could single out countries like Cote d'Ivoire as some of the countries that have actually taken steps to ensure that the risk of foreign exchange to some extent has been mitigated. And when we come back now to the liquidity risk, what African governments or what actually issuers of those instruments in the market, because it's not only for the governments, we actually have seen parastatals and we've also seen corporates issuing out quite a whole lot of dollar denominated or euro denominated kind of instruments. Now, in terms of liquidity, what we have actually seen is that starting from the whole story of actually issuances having happened about 10 years ago and coming to maturity, there is a huge concentration of maturities coming up in the next 2-3 years. It is a very important time because even before the onset of the pandemic, that was a problem on its own. How were African governments, how were issuers and promoters of projects going to pay back some of those loans and some of those Eurobonds? So what matters now, in addition to all the efforts that are going on in the background in terms of seeking moratoriums and so forth, what governments and issuers of investment instruments need to be looking at is how they can now start to look at restructuring some of that debt. And actually, even the new debt that they are looking at is not necessarily to restructure just to make it longer, to actually come up with a structure that actually gives them time and capability to repay it over probably a longer period of time. So those are some of the things that actually can, investors can look at, or actually that governments can look at.
Thank you very much, Emmanuel. There's actually a question, I think a follow-up comment or a question, but I'll just move on to Anne for now, and then maybe we'll come back on that question or response. So Anne, investment activities are governed by regulatory requirements and ethical conduct. Can you outline some of the due diligence challenges investors face around regulations, ethical and operational risk on the African continent, and how they can go about mitigating some of these risks?
Sure. So the classic risks for investment in Africa include political instability, expropriation, currency inconvertibility, devaluation, and unfavorable regulatory changes, as well as commercial and operational risks. Broader business risks include ineffective legal systems, interest rate increases, commodity price inflation, fluctuations, uncertain returns, unreliable off-takers, etc., and non-transparent procurement processes. But there have been substantial improvements in addressing these issues in recent years and improving the regulatory environment. But we're not quite there yet on the African continent. In fact, a recent survey done by Baker and McKenzie told about 300 business executives, and 50% of them considered Africa to be the most challenging region from a risk and compliance due diligence standpoint. So customer due diligence is very critical to reaching investment decisions. It is important for pricing and also completing transactions and ensuring the long-term success of those investments. Unfortunately, some countries still have very opaque legislative and regulatory frameworks and unpredictable legal processes, which are inconsistent with enforcement. And even the statistics that are churned out may not always be reliable. So due diligence in normal times takes long in Africa to complete. With COVID, it takes even longer, and there are additional issues or hurdles that we need to get past. The issues that certain companies have in operating in Africa are not just local laws, but they also have some extraterritorial legislation that they need to comply with. For example, the US Foreign Corrupt Practices Act or the UK Bribery Act. So all these have to be taken into consideration when investing in Africa. They must also ensure that their business partners and sometimes customers follow transparent practices and are not implicated in corruption scandals or unlawful acts. Customer due diligence is further complicated when the assessment and management of certain ESG, environmental and social risks, falls to the government or third parties over which the client has no control. And for infrastructure, this may be when in the early planning decisions, when you're deciding on a project site, and these can affect huge communities or the environment itself. So what action can you take to mitigate these risks? Well, there are certain actions you can take, but it is very important to tailor them to the project and to the country. For example, some African countries have more stable political systems than others, so political risks would be lower, while others have judicial systems that can better resolve, for example, commercial disputes. What is most important is that commercial partnerships or PPPs allocate risk to the parties most able to handle them. So what do I mean by that? Well, the private sector is usually best placed to hold the financial construction and operations risks, while governments could handle foreign exchange risk, fuel supply, and country risk. So governments themselves have to do quite a lot to enable business to continue. And governments must assure consultations with all stakeholders and end users to minimize things like ESG and commercial risk. The outcome of that is when governments do manage these risks effectively, they can obtain projects that require lower returns. When the private sector is expected to cover most risk, the private sector will price those into contracts, resulting in projects that are more expensive. There's also the problem that risk is perceived to be actually higher in Africa than in reality, and that investors do not trust governments to handle their part of the investment. Therefore, multilateral institutions such as the African Development Bank, MIGA, or IFC may have risk guarantees or first loss provisions. These are instruments that investors can use during these sort of hard times. These guarantees or first loss provisions, they're hardly or rarely invoked, but their existence in themselves give the private sector more confidence to proceed. the mere presence of such institutions, such as the one I work for, Africa 50, in a deal provides de jure risk mitigation, and people get comfort in having big names also in the same investment. I'll talk about the impact of COVID-19 in particular. The pandemic has caused businesses a huge amount of uncertainty, as we all know. We have seen the need for investors now to reorganize, reprioritize, rethink their strategy, adapt to new and challenging ways of doing business, and in many cases, simply reacting to circumstances which may have been unforeseen this time last year. So it's very much acting on your feet. What has been noticed is that deals that were in the more mature phases of investment prior to the onset of the pandemic are progressing, but those investors are now forced to feel their way through new logistical compliance and regulatory challenges. However, projects that were more in the early stages of development or more in the infantile stages prior to the pandemic, either being postponed or cancelled. So a lot of due diligence on an investment, as we know, requires on-site visits, meeting people face to face, and this is particularly important if you're intending to invest in a new country, for example. These face-to-face meetings are where you negotiate permits, licenses, build rapport with counterparties, navigate local systems, meet government officials, just simply learn about customs and the way things are done in that country, and simply getting a connect between reality and the figures and written documents within the context of the country. And these meetings face to face is often the very start of a long-term relationship between the financier and the investor company or government entity. With lockdown still in place in many African countries, of course, this is no longer feasible. So we need to find new innovative ways of working around it. There are some sub-Saharan African government agencies and parastatals struggling to adjust to remote working, which means that documents are not digitized. So obtaining corporate information or notarized declarations or filings or correspondence with regulators or government agencies, for example, to even in simple places of, anti-money laundering legislation to identify beneficial owners is going to be a struggle. We may find that bureaucracy has increased amongst those government agencies and ministers who prefer face-to-face discussions. And what is also very important, site visits are very crucial to conducting environmental and social due diligence and environmental and social impact assessments. So some governments in Africa are taking action. We've seen Kenya and Cote d'Ivoire, for example, taking action to put corporate registries online, and Mozambique and Angola are putting digitized documents of company registration information online. So they are taking some action. The basis elements of conducting due diligence have not changed due to COVID, but there's increased reliance on digitized documents, e-signatures, etc.
Right. Okay.
I could go on forever. I'm sorry.
Yeah, I can tell. We actually have a few questions that you might probably, I think you've kind of touched on some of the points in the questions, but you might be able to give some more clarity around it. So one of our questions is, if publicly available information for conducting due diligence and identifying risks is not easily available, how often are alternative data risk models being used? That's, yeah.
I'm happy to take it, but I'll let
Sure.
Emmanuel speak first.
No, okay. Well, the issue about publicly available information, I think let's look at it probably on a going forward basis, looking at the future with the COVID-19. Given all the challenges that Annie has talked about, the biggest challenge that you have is probably how updated the information is, how relevant is it? We know that on a normal day basis, we have a challenge of not having some of the information at all. Some of the statistics and the data, even from the different kind of sources, sometimes is not updated for a couple of months, or sometimes it's not updated for a couple of weeks.
Right.
Information is not up to date. Now, what needs to be done, I think, with that is government should engage the institutions or financial institutions that are actually typically the providers of such information, and come up with a digitized bank data of the information. I think that is actually like one of the solutions that the governments or actually like analysts can work with, because information is available, but it's available in different kind of pockets. Probably a bank or an analyst with a brokerage firm or a stock exchange or an SEC, you know, information is in different kind of places. So the challenge is actually like to integrate that information and put it together in such a way that it feeds on a more or less like on a live basis into a database. I think that is one of the things that actually like, which will be very important.
Right. Thanks a lot, Emmanuel. And if you could maybe speak to, I think the question is asking as well for if there are any alternative data risk models being used. Do you have any comments here?
Yes, absolutely. Investors can use other methods of gathering information on counterparties or potential investee companies. They could speak to partner companies, other commercial institutions who have done business in that environment, in that local context. One of the key things I would advocate is soliciting local market feedback using intelligence, risk advisory firms, especially consultants who have a footing locally. And so they are closer to what's going on in reality on the ground, and so have their ear to the ground. This is particularly important during these times when you can't personally visit or meet the relevant people. And it's also particularly important because of the pandemic, you really need to work with local partners. But partner institutions, if you're familiar with the big entities such as AFDB, IFC, etc., those are key people who have a significant experience of working in these environments, in these restrictions, within, and they're able to navigate certain things which perhaps a smaller company can't. So partnering with bigger firms, talking to them informally, nothing stopping you talking to them informally, within the confines of confidentiality, really.
Okay. Emmanuel, this question is for you.
Okay.
The mitigation of FX risk that you spoke about in Senegal and I think it was Burkina Faso, somebody's asking, if it is related to the dropping of the franc to the eco?
No, it's. I would say it's not in that line of thought. What we are talking about is that there is some kind of a relationship. Let me just step back a little bit and say the opportunity that countries that have got a peg to the euro have is that they have an access to a deeper or more liquid market in terms of the euro dollar. So this is basically a euro dollar sort of a hedge. Now, what we're trying to advocate for, or actually what we're trying to say, is that the euro dollar depreciation, appreciation of the local currency is actually like linked to that in a very big way. So the CFA currently, as we speak, before the echo kicks in, is still pegged to the euro. So it is basically the euro-dollar hedge. Now, what is the background of that? The background of that is a lot of African countries, even those that are in the Francophone zone, had managed to go and raise euro bonds in dollars over the past decade. And as the euro depreciated, they found it a bit getting more and more expensive to service that euro bond. And it is not only for the euro bond, it is also like for any other bilateral loans, and it is also like for anything that is related where the loan or actually the exposure is in dollar. It becomes more expensive along the way. And as you go even now to the maturities, the same story I was talking about, the liquidity, we're now going now to a bullet payment. 2020, 2021, you're probably facing a $1 billion payment. Yet, when you borrowed, if we look 10 years back, euro dollar was at 1.4 something, or maybe 1.5, somewhere there. Yet, you are now paying back that $1 billion when euro dollar is about, let's call it 1.10. How much have you lost in terms of value? In fact, there was a time when the euro dollar went down to as low as 1.03. Now, what that means is that all that excess, you have to be raising it from taxes, or you have to actually like make certain sacrifices to say, what do I go without as a government or as a company? So the euro dollar gives an opportunity to, especially to corporates, state-owned enterprises and governments that are in the Francophone zone that are using the euro as a peg. But that does not mean also that countries that are in the other zones where they actually like are facing the dollar directly cannot do that. They have an opportunity actually if they liaise with providers of services like that. Some countries are a little bit way ahead in terms of having facilities or products within the market which the governments can relate on, corporates can depend on. However, it is not really like a very deep market. It is a market that is still developing, and I think it's very important for us to urge the authorities to continue to develop those kind of capabilities, because it helps to save money. And it also like helps in certain situations where your debt service ratios are actually impacted, not necessarily by the fact that you cannot raise enough taxes, but simply because the exchange rate has just like gone out of certain ranges. That's all.
Thank you very much, Emmanuel. Anne, I think this question is probably best answered by you. What is the role of financial institutions, that is African private sector financial institutions, in mitigating the risk that investors face in doing their due diligence? So I think you spoke about developing local partnerships, etc. I think this point probably is geared towards that.
Yeah. It's you know, okay. You specifically said financial institutions, so I will talk a bit about what we have seen on the ground. Okay, what this pandemic has actually done to potential or investing companies. What we've seen is that there have been liquidity issues. We've had delayed payments. There's been lack of hard currency. All this Emmanuel has already alluded to. There have been currency fluctuations, and there have been knock-on effects on supply chains. So some projects may either grind to a halt or incur delays. For example, we've seen projects where key persons are expats and they have left the country as a result of the pandemic, causing delays to that project. So Emmanuel has already spoken about the need for institutions to look at the potentials. You don't want to bail out on an investing firm. You want to see it to fruition. You want returns on your investment. You want to know that that investing company will succeed in these hard times. And so, as Emmanuel said, you'll find that a lot of institutions have had the need to consider restructuring debt. Organizations have had a huge impact, that their financial performance has been hugely impacted by some of the issues I listed earlier. So conducting due diligence on financial performance of potential investing firms or existing investing companies would be absolutely crucial during the pandemic. The need to continually monitor the situation, to have that rapport with your investing firm, to keep the dialogue open, and continual engagement is absolutely crucial.
Thank you, Anne.
You know, I just wanted to add on one small thing on your elaborated answer, Anne, and thank you, Ashi, for that. You know, there's this situation where I just want to paint a picture of banks doing something that could be literally similar to due diligence, right? You have banking supervision departments in the central banks or regulators. In the same scenario, you also like have SEC, I mean the Securities Exchange Commission or the Stock Exchange, having some kind of a similar kind of a role. Now, what you actually probably need is to do away, or actually like to evolve from the situation where you manually, as a bank, have got to input information into probably either an Excel or some other system, and then it transmits to the regulator. One of the ways to actually like get very good data is to ensure that there is connectivity between financial institutions and their regulator. So in such a way that whenever you are actually like looking at a balance sheet from a financial institution's website, on the central bank website, for example, or on the stock exchange, if they are listed, then you're actually like looking at data that is actually up to date and data that is actually like been verified through systems. So I would say digitization should actually like take another leap forward instead of actually like having some siloed sort of sources of information, like I said earlier. I think that would be like another way the financial institutions can be of help.
Sure. That's very helpful, Emmanuel. I had a few more questions that I just wanted to quickly run through. One question is asking that what steps can we take to change the narrative and perception of Africa as high risk? So Anne had already alluded to the fact that there's a perception that Africa is higher risk than it actually is. What are some of the steps that we can take to change that narrative? And there's a follow-on question which says, what are considered challenges, not possibly opportunities for us to look at? How businesses as viewed globally in a world where we risk dehumanizing our businesses if we continue in the path we are on?
Sorry, can you repeat that last one, Asi?
Yeah, I think I'm going to take make an assumption here that what the person is saying is, if we apply global standards to our African businesses, don't we risk dehumanizing our businesses? And I mean, correct me if I'm wrong, whoever asked this question, but yeah, I think that's the angle they were coming from, that Africa is viewed as high risk, but if we apply global standards to our African businesses, don't we end up risk ending up dehumanizing the businesses in a way?
Okay, I think I sort of get where you're coming from in terms of the perception of risk. I think it is a very important topic, the perception of risk. I was in another session earlier on today on this same platform, and there was a discussion on the perception of risk in Africa. Now, the most important thing for the perception of risk is, first of all, let's continue to tell our story to the rest of the world. That's number one. And number two, we do not necessarily always need to tell our story to the rest of the world. We need to tell our story to ourselves. It is very important that our local investors are also quite comfortable with the kind of investments that we actually have. It is very common for the big infrastructure projects to actually like come from abroad, lock, stock, and barrel. And then we only like start to see something going up in some corner of the country and say the investors came from there, the builders of it came from some other place, and so forth. So what we need to do is to include a whole lot more of the local content. I mean, I want to say it from an economics perspective and say the local content inclusion should actually like take precedence so that local businesses can actually understand and also be involved in such a way that there is some kind of a common goal sort of a scenario. So I think that's one of the ways to actually like make sure that if the local populations are actually involved in projects in a very big way or in a more detailed way, they will be also be able to explain the risk or actually be able to explain what exactly is the expected outcome of any project or of any, even if it's portfolio investors or if it is bonds or if it is equity. If there is a local good participation, there will be a story that will be told from ground up. That is another way.
Thank you, Manuel. Anne, you had something else to add?
Exactly what I said earlier, you know, the perception of risk when you do business in Africa is not always the reality. There's always a huge perception that Africa is risky, and in reality, when you do business, it's not, these risks are not insurmountable. So Africa needs investment. There's a huge gap that needs to be filled, and the governments, individual African governments, have a huge role to play in mitigating those or squashing those perceptions. You know, whether it's strengthening the legal framework, whether it's putting in place the judicial framework. You know, they have a huge a part to play in sort of responding to those perceptions of risk in Africa. And so what COVID has done is again shifted government's focus. You know, you'll now see governments focusing on healthcare, on social infrastructure, and ICT, which has been a huge, you know, area of development post-pandemic and during pandemic. So there has been shift in focus, but the governments also need to look long-term and see what can we do to attract the kind of investments we really need for the sake of our communities.
Okay, thank you, Anne. I guess kind of just following up from that point you made about what do we need to invest in longer term. There's a question here that is asking that how can African countries use training to reach the grassroots with information on mitigation? Because most people are not digitalized, or they don't have access to digital platforms. So how can African countries use training to reach out to some of their people in the grassroots?
Shall I?
That,
As I said, you know, ICT, for example, has come out as one of the most needed sectors during the pandemic, whether it's, you know, track and tracing, etc. So we also need the knowledge base in order to make those projects happen that will help the situation, and for governments to, you know, communities to progress. There has to be a lot of investment on these fronts. In particular, ICT in particular has, you know, needs a lot of investment in Africa. We're not quite there on a level playing field as yet, but the pandemic has only brought to light how important it is for us, whether it's, you know, the need to convert to e-signatures, or the need to have digitalized documents. We really need ICT to be a core focus for going forwards.
Emmanuel, you had something else to say? Thanks, Anne.
I think I will agree with Anne, but I just want to add just one small item in terms of if we have the challenge in Africa of certain communities on the grassroots that are not included, or actually like we have the inclusion story coming through. The biggest challenge with the inclusion story is that we need to be able to give the cause, the reason why somebody should be really interested in the training. And one of the benefits could actually like be financial, not necessarily thinking about people being paid to be trained, but to figure out how they can also participate in the economy of those projects or those investments. So then people can take some kind of, we can take some kind of an interest in that investment. You have different kind of models where maybe I've seen models of some agro-based projects where the communities around the nucleus farm actually benefit from some kind of training in two ways. The first kind of training is to say, if the nucleus farm is doing, let's say, blueberries or something that is not generally commonly farmed in those areas, then you actually have outgrower schemes to train the surrounding communities to farm blueberries. So that is one way of actually training and including the grassroots. Another way is to actually like say, some of the projects still sitting on the same example of agro-based agro-processing. Some of the owners or the promoters of projects have got capacity and experience in a completely different kind of thing. Assuming that the owner of a project that is sitting in a different kind of place, one of his expertise is just stock markets. Why not just like be part and parcel and take an initiative and be a stock market person just to some of the, I'm imagining rural areas here. So that's why my example is actually like looking at some of the situations like that, because it then becomes an issue of inclusion. That's how I look at the training aspect of it.
Thanks for that very practical example, Emmanuel. I guess I'll say a two-in-one question. One of our audience is asking what companies are available in Cote d'Ivoire specifically that are skilled in due diligence. And another audience member is asking how can you engage local risk management firms who have the local knowledge and expertise? So I think both the questions are related, so we can answer both.
Okay, I think I'll answer the Cote d'Ivoire part, and I would say I read the code of conduct of this session, and I will not advertise. However, it's really very important, and I'll take it from Anne's mouth, that it is important to look at what the local-based advisory firms can do for you. Matter Capital is a local advisory firm in Cote d'Ivoire, And we have accompanied our clients in a lot of some of these risk aspects of looking at their business, because what we do is not necessarily just to analyze the books or to analyze the numbers. We go far and beyond just analyzing the numbers. We actually like look at stress scenarios. Stress scenarios become really a very important aspect, especially with COVID-19 coming through, because what used to be like very normal kind of a stress scenario is no longer a normal kind of a stress scenario. We have seen currencies depreciating 41% in March, April. It happened in Africa, in some parts of Africa. We have seen yields on bonds actually depreciating from 5-6% yields where they normally trade to as high as 14%. Now try to look at that in percentage terms. That is actually quite huge. So what we do is we run models to try to see at what stage do you think you need to actually like cover this kind of risk. So we then come up with the different kind of recommendations. But working with advisory firms is just like one of these things. It's not me saying, it was Anne who said it. just
Right, but I guess the other part of the question was, how do you engage? How do you reach out? Is there a database? Is there a place that our audience members can go to find local advisory firms to partner with?
I think it's not like there is a database where you can say, now I'm gonna look at this whole list and I choose this one. Like in many things in business, it is a case of reaching out to what you have heard by word of mouth or by their advertising. Who is somebody? But you can actually like look at the track record, right? Once you actually like look at a particular advisory firm, look at their track record, look at which names they've dealt with. Track record of the names, the size of the deals, the structure of the deals, the complexity, and the simplicity as well, because it's no longer just about coming up with a complex idea. It's about simplifying ideas and coming up with solutions. Just look at the track record and you will be able to really like identify the one that was for you. If it was me asking the question, I would just like, no, I think I can just like go to Mata Capital, but I'm just joking.
Right.
But there's a lot.
Right.
And do you have any insights on this?
Yeah, I agree with what Emmanuel said in terms of, you know, looking at the track record of these companies. There are many out there, and I'm not going to advertise any one of them. Africa 50, we work with many of them, and it is actually important to work with many, because you'll find that some of these consultancy risk advisory firms are better in one location or one country or one sector than the other. So it's very, very important to ask the right questions. So once you've got a list of names, either through the advertising or word of mouth, it's very important to ask for their previous experience in that country, in that sector, with that size deal, with and get a feel for how good they are. Ask them what methodologies they're going to use. Do they have people on the ground in that country? Do they have connections with government agencies? You know, what kind of systems do they use? Do they do sanction screening? Do they do interviews with key persons in that locality? These are all the questions to sort of, once you've got the list, to almost say, yes, okay, I think this one might work better for me than that one. So these are just ideas.
Okay, unfortunately, we've run out of time. So I will ask one last question, and then we'll have a wrap up. So the question that was asked is, in light of all we've said about COVID-19 and the changes that it has wrought, given that there's a lower prevalence of COVID-19 in Africa, can we see that as a mitigating factor? You know, are there any positives for Africa in that narrative?
I would say it's a case of saying proceed with caution, because we all know the impact of COVID-19. And I wouldn't want to say that there is a country which is immune to the impact of COVID-19. So it's a matter of saying this is an opportunity with less prevalence. It's an opportunity for us to proceed with caution. If we are to reopen our economies, if we are going to take decisions and to look at other factors, we just proceed with caution. Because the problem with assuming that the impact has been low and then we go at full speed, it might actually like turn back and hurt us, and we might not be able to recover once the trust is lost. So my final thing would be like to say, proceed with caution. How do you proceed with caution? Ensure that stress testing is a very important aspect. Where you used to imagine that your revenues might be impacted by 25% in a bad case situation, try to imagine it probably double that. And then you can come up with your different kind of scenarios, and you actually can come up with an answer that actually, like, at the end of the day says proceed with caution. That could be like the way I see it.
Okay, thank you, Emmanuel. Unfortunately, we've run out of time, so I can't give an opportunity to also contribute. Just to remind the audience, there's another session after this, the Changing Investor Perception of Risk in Africa session. So those who have already registered for it should please join that session as well. Thank you so much for participating. I think the main messages that we can take from this panel is the idea that if you want to do, first of all, that the perception of risk in Africa is not necessarily accurate, that investing in Africa is not as risky as might otherwise be touted. But that being said, be aware that there are certain inherent risks that you need to manage for. And in managing these risks, you should partner as much as possible with local institutions, local firms, and ensure that you're considering liquidity risk, FX risk, and that you are also considering things like operational risk. In light of the current pandemic, the way of conducting business has changed, and we need to also adapt to meet those changes. I think in a nutshell, those are the main messages that I would say came out of this panel. Thank you so much, Emmanuel. Thank you so much, Anne. And have a great day, everybody.
Thank you.
Okay.
Thank you for the opportunity.
Thank you.
Bye-bye.
Bye-bye.
Bye-bye.